Good afternoon, everyone. Looks like the weather outside is keeping some of you away, but we'll try to try to make this as insightful and interactive as possible. We'll start out with a short introductory round, and I would suggest Max.
Yeah, pleasure. Thank you so much. My name is Maximilian Jahr. I'm working for Greensets Group. Greensets Group is founded in 2009. One of the successful EPCs of the second generation. Has built more than 2.6 gigawatt of total capacity. Like many EPC of the solar industry, there was a large period where the construction of solar power plants in essence was not very attractive, and the market was difficult. So the company decided to make, like many others, a strategy step, and become an IPP. So since 2018, we're developing projects in more than 25 countries in order to construct them and operate them, and I'm very happy to lead that business unit since 4 years.
Thank you, Max. Kevin, do you join us?
Yes, good afternoon, everyone. So NCR, I'm investment director for. They're an Irish-based investment manager. So NCR originally actually is a 40-year-old business formed by a family, and it used to stand for National Toll Roads. It had the private toll roads in Ireland, and for 30 years it invested off its own balance sheet on infrastructure across multiple platforms and geographies. The last 10 years, the business pivoted to become basically a manager of other people's money, and we launched our first renewable energy fund in 2015. That was a 250 million euro long-term investment fund over 25 years with institutional capital, so basically pension fund money, and that was for onshore wind in Ireland and UK. The second fund is a 300 million euro fund. That was invested again 29 years, so it was again long-term pension fund money, onshore wind, solar PV, and battery storage in multiple European markets. We had the likes of a lot of institutional capital, likes of EIB, of well-known pension fund money. We've just launched our third fund, which is a partnership with Legal & General Investment Manager, which is their largest UK pension fund. That will be a 10-year fund. We achieved first close there in March for 390 million euros. And again, we're doing onshore wind, solar PV, and some offshore potentially in European geographies. And I've been with the business about 11 years, and I've been just acquiring projects throughout Europe.
Thank you very much, Kevin. Andreas?
Thank you. So my name is Andreas Pfeiffer. I am the managing director of FRV Deutschland. FRV is a project developer. We do ground-mounted PV and BESS. Currently active in 30 nations. 12 of them have FRV as single entities, basically doing their own development. The other nations we work mostly with co-developments with local partners. A lot of them in Europe. Germany is actually our newest unit. We only started here last year. Focus here is again ground-mounted PV and BESS development. So I look forward to this panel and seeing what exactly we're hearing on topics of renewable energy financing.
Thanks very much, Andreas. And last but not least, my name is Martin Pantic. I'm acquisition manager at Sonnedix Germany. Sonnedix is an IPP founded in 2009. Currently we have approximately 2.5 gigawatts of solar and wind operating capacity worldwide. We invest only in OECD countries, currently 10 of them, spanning Chile to Japan. And in Europe, we are in Portugal, Italy, Spain, France, UK, Poland, and Germany. Right, so let's get into the discussion. I think one of the major points for investors at this time, and this is something that I've also been facing, is we're living in an environment with high inflation, high interest rates, more challenging lending conditions, backwardation in the electricity markets, and this obviously has an effect on equity returns as well as price that investors are willing to pay for project rights as well as operating assets. And so the first question that I'll pose to my fellow panel members is, what is your view in terms of higher interest rates affecting equity returns, discount rates? What are possible implications? What are the challenges that we're facing? We talked about in environment about potential impairments of assets that have been bought during in past few years at very, let's say, high prices and very favorable lending conditions. Now the environment has dramatically changed. How do you see this? How is it affecting your investment decisions? Who'd like to answer this question?
I'll go first, maybe as the equity on the panel. I suppose we kind of, it's all, you know, cost of capital is a significant input in projects. So it's very transparent, clearly the cost of the base rate has gone up, so the cost of debt has gone up. So from an environment, say 18 months ago, with base rates close to zero, and let's say if you throw in credit margins on average, let's valuation on projects from just a purely cost point of view, and clearly it affects gearing, but it also has, I suppose, a secondary impact potentially on equity returns. It's not as clear cut, but clearly at the back end, that equity risk premium that's traditionally been there, where again, just given broad numbers, when you were traditionally maybe buying projects, let's say over the last 18 years, when let's say debt was at 2%, and could, you know, buying projects somewhere between 5 and let's say 7%, depending on the nature of the market, etc. So you were looking at a kind of an equity risk premium about 300 basis points or so. So that definitely has got squeezed. And you know, investors or people that we raise capital from are kind of looking at that, and you know, if you're suddenly if the debt has gone in at 5% and your equity is at 5%, that doesn't quite work given the nature of the risk. So hence, so clearly there's a desire, requirement for equity returns to increase. The question is by how much. Now, I suppose and which ultimately will lead to impacts on valuation. But that's one side of the valuation thing. But I suppose, as we've seen over the last 18 months, there's been a kind of a few breakers in terms of kind of offsets on valuation, in terms of deals and valuations. First one being obviously power prices have, in certain markets, you know, all markets have gone very high. In some markets where it's merchant exposure, that has kind of offset from a valuation point of view, and potentially so to kind of keep valuations maybe in assets. And then secondly, you do have the supply-demand imbalance where huge amount of capital chasing not so much projects, but that has begun to filter out of the system. So there will be pressure on returns. This was the other point I would make is that, again, mentioned we're raising capital. One thing that we've noticed, like you're constantly raising capital, one thing we've noticed, particularly in the last 6 months, is that the fundraising environment has really fallen off a cliff, generally for infrastructure. You're competing against the bond market as well. And, you know, and it's all about returns and doing that. So there's demands coming on for higher returns. And again, you know, that's a thing to be managed. Whether this will continue, I don't know, but it is a current challenge. I think the second thing that you referred to there, Martin, which is kind of very important as well. You have funds like ourselves and maybe long-term owners of assets are passing their financial year end, and we have this concept where, you know, portfolios get marked to market with each year, and the discount rates that are being applied have increased. What does that mean? Valuations are being affected, which can, you know, hit P&L. So it's very, very conscious. People, you know, longer term are looking to avoid that. For the last few years, you've had a scenario where it's the opposite way, where everything has as prices go up, discount rates go down, it's kind of virtuous circle, assets going up, and then that attracts in more capital. So it is a challenging environment at the moment. It needs to be navigated. But I suppose maybe sounding a positive, you know, the industry will adapt. It's like any other, it's a very renewables in particular across Europe. It will adapt to it. It's another cost challenge, and we will get through it because there's only one direction to travel.
Thanks very much, Kevin. Andreas, would you like to share your views how this is affecting your investment decisions here in Germany?
Sure. From a developer's perspective, we've seen a bunch of factors basically running against each other. You have a very bubbly market. You have institutional investors that are pushing into the development market, trying to build up their own development teams in order to secure assets for themselves because market valuations of project rights have gone through the roof, particularly in the last year. So there's a bunch of new competition on the one hand that should be driving prices down. At the same time, you have political goals that sometimes seem, let's say, I don't want to say dreamy, but at least not fully connected to reality that I am seeing from a development perspective, but yet support the trend for high valuations, given that everybody is expecting that at some point something is going to change in order to make these political goals actually happen. Third pillar that we just talked about, where all the details on the financial side, there was a bunch of capital floating around, and this just became a very attractive investment opportunity for ESG reasons that we heard about before, purely financial reasons as well. So there's no clear picture yet. What we're definitely seeing is a trend towards a market correction, lower returns on assets, and exactly how it's going to play out, I don't know yet. This is an opinion piece. I think in 18 months or so, we'll find back to a new norm, basically. We'll see some correction in the energy prices. We'll see what the path forward for the next 5 to 10 years is going to look like.
Okay, thanks very much. A follow-up question. Given that FRV belongs to, if I'm not mistaken, a Saudi investor, and obviously there's the risk of diversification, you allocate your funds to those countries, so probably with the highest returns. How is that affecting, for example, investment decisions here in Germany?
It's a good question. I cannot speak for our investor, the ALJ Group. What I can tell you is that we're not looking at it just from a pure return perspective, or at least not without weighting it. Germany is attractive because it is a relatively secure market, and valuations, or rather the IPP business that we're pursuing here, is set to remain high value, at least for the foreseeable future. So what we're really seeing is a question of risk diversification across the markets that we're active in. As I said before, it's currently 30, and we're expanding that every year.
Thanks very much, Andreas. Max, could you provide your views? I mean, Green Cells is active in a number of European markets.
Yeah, I mean, the gentleman basically summarized the situation very correctly. It's very obvious. Interest has went up. Electricity price went down. In the end, that will mean that the equity return rate needs to lower. So basically, everybody looking up to lower numbers than looking up before. But the raised interest rate for sure makes the funding, like Kevin already explained, much more complicated. So on the one hand, we need more equity return rates on solar projects at the moment. On the other hand, it's difficult to achieve since everything basically went up. What happens in the end is that prices will now need to go down from all the stakeholders which are basically involved to bring a project to life, to bring a project to operational phase. With developers who basically are not ready or not accepting to take the hit basically on the valuation. So they wait for the moment. Then we have EPCs in the middle. They basically have also at least the same cost like before. Prices are coming probably later to the point, slightly lower at the moment, but also the high electricity price over the last 12 months made it very difficult to save on the components to construct assets. So who's going to take the hit in the end? That's the question at the moment. I see personally everybody kind of in a Mexican standoff, waiting what will happen for the next 6 months. What happens with the windfall taxation? What happens with the electricity price cap? The thing at the moment is a very curious market. Everybody waiting for the next big move to happen, and I'm curious to see what it is.
Thanks very much. think from an investor perspective, especially if you're investing in greenfield development or greenfield assets, what I've personally seen in the market is that many developers are still banking on project prices that could have been realistic and Q4 if Q4 prices from last year were still available, but the market has
developers at the moment, yeah? Developers who have ready to build assets where they have basically developed the project over the last 5 to 6 years. So one lifetime opportunity to bring this project ready to hold. And then we have very structured, very well experienced global developers, which business model is basically to flip projects. For the second style of developers, I think the correction, like Andreas mentioning, will happen in the next 6 months because they understand it's their business. They need to flip, they need to reinvest money. So they will adapt the prices to the new market values in order to have attractive prices at the moment. These small developers, which is basically these developers which we want, people who basically driving energy transition forward, who want to be a personal IPP, who want to secure financing, want to invest long-term into projects. For them, I think it's very difficult to accept it at the moment, and this will take, from my experience, still 1 to 2 years until they accept that these prices are no longer valid and available on the market.
Thanks very much, Max.
Yeah, I'd echo that. I think there's definitely two different skills, just in terms of the experienced people who flip, who kind of maybe go by annual calendar financial year-end targets that they've mature projects that they need to sell. They know the market very well. They know where it is, and I suppose the expectations are set. It's not saying you want to try and clearly as a developer get the highest price, but there's an understanding where the market is and what it is. For earlier stage developers, it is trickier. I suppose the thing is they have the luxury of time. If you hold on, they can hold on to the assets. The other thing where it comes to is structuring, innovative structuring, where if there is a need for capital, that if things to do innovative structures, where if there are upsides, where if costs come down or prices go back up, that the developer gets value for that in future. So I think you'll see a lot more of that going forward to see that in the long term, if there is correction, that developers do get their fair share.
Thank you, Kevin. Andreas?
I think I have only one thing to add to that, particularly from a developer perspective. Starting a greenfield, you have to look at the fundamentals of the contracts that have been closed over the last 12 to 24 months that are radically different to how things had been done up until that time in Germany. You saw price introductions, profit share, revenue share becoming part of the contract structure in Germany, things that didn't exist prior to that. And that became, euphemistically, let's say, bubbly. So a bunch of these projects will either have to be shelved, at which point they will no longer affect the price, or have to be renegotiated. Now, if that kind of renegotiation actually can happen, we might see the larger influx of new projects at different valuations entering into the market. Because, again, from a developer's perspective, what actually is your cost when you're trying to flip a project like that? You've already established the connections, you've already signed the contracts, you might have to change some of the terms. How easy that is will determine how quickly it goes. But whether you sell the project at 50K, 100K, or 150K just determines how much money you make on it, not whether or not you make a profit. And that really plays towards the landscape of smaller developers in Germany that you were talking about before. Developers who might sell a project at the ready-to-build stage, but are not really considering the end-stage turnkey installation that might be producing energy.
Max, do you want to add something to that?
No, I think Andreas basically brought to the point. That's the case. But like I said, there's people who say that the energy asset plans as a whole, basically as COD, knowing that there needs to be the installation on top. There's people just looking at different stages, and I think like this kind of developers we're speaking at now at the moment, they're just looking at their part. They basically don't care what's coming afterwards. So that's definitely a very important point. Yeah.
Thanks very much. Perhaps just adding some data I've received out of the market. I've seen, for example, the variable component of land leases in Germany go from below 5% to 7, 10, even 25%, which I find quite unrealistic. But I believe the process at some point has to readjust. It's unrealistic to expect, at least at the current price levels, someone to pay 25% of revenues to a landlord. And from what I hear from colleagues in other jurisdictions, it's not necessarily the case, for example, in Spain, and perhaps in France. I don't know what your perspective is on that, in like retail sense.
Yeah.
There.
I mean, every market has the specialty. In Germany, like for the last couple of years, the land was always the bottleneck. So securing the land, getting the land somehow under control, and getting it under contract was always the key milestone of a development. In Spain and Italy, land has much lower value in terms of the development step, since the grid is much more stable. You can basically acquire large plots of land in Sicily or in Spain, which are almost a desert, but the problem is then there is no grid connection. In Germany, we have thankfully until now the quite good infrastructure, so that basically every large secured land plot has an affordable, quite sensible access to the grid, and therefore from my perspective, the land price in Germany always went so crazy, because having the land kind of 60, 70 hectares in Germany, we're secure that you can get an affordable connection to the grid, which is not secure in other jurisdictions. Like you said, but everything, let's say above 5, 6, 7% of revenues per year for the lease of the land was always unhealthy, and I think it was always a very short basic just to secure the land now. And like Andreas mentioned, these are the developers, these are the market participants who need now to pay the price. They need to renegotiate, because this is under the current circumstance, with the interest, with the given electricity prices, this cannot realize. No bank will, secure you the capital to construct such an asset.
Thanks very much, Max. Moving on to another topic, which is the lending conditions. We know that interest rates have risen, and depending upon the market, here in Germany we have KfW lending, which is probably the most competitive. There might be a couple of banks that can undercut KfW because they have access to their own deposits. But how would you say lending conditions have changed on par with the higher interest rates? Would you say that, I don't know, DSCR, DSRA requirements have had to adjust, or they've remained pretty much the same?
Yeah, I think we've done a fair few financings over the last 12 months. Conditions really, in fairness to the banking industry, have not materially disimproved. There is pressure, no doubt. Margins have increased, as in the credit margins, but nothing to the same extent. So, like I'm not sure if there's any bankers in the room, but there will be. It's ongoing pressure. Like in anything, renewables is one part of the. It has to compete for capital, but so far, we haven't seen material. Well, we haven't seen, certainly in our organisation. There is still value there. It is harder to access it, no doubt about it. Margins have gone up, but nowhere near to the same extent that the base rate is really causing on financing. So generally not too bad, I would say.
Thanks, Kevin.
I think Kevin had the right point. I think in the course of last year, interest went slowly up, and the electricity price as well. So there was kind of the same level, and at the end, the attractiveness and the availability of financing just shifted. Got more money, you had stronger revenue streams, but you had a little bit more interest. So it was basically leveling it up. It was okay. What we see now for this year definitely is much lower electricity price and much higher interest. So there's a completely vice versa effect. From my perspective, you're definitely not getting the gearing like last year for your assets. It's much more difficult to reach debt service coverage ratios with the same numbers like last year. If you speak about senior structured financing, senior capital for projects, last year basically every German bank was throwing money at you, so you could basically finance every project 10 times, because it was very important for them to gain market share. At the moment, I see much more banks getting very conservative, even the most conservative electricity curves like Baringa, Bloomberg, like we see today in the morning. Even they are getting questioned, and it's much more challenging, much more conservative look on the market itself and on the future of electricity prices.
Thanks very much, Max. You touched an important point, electricity prices, and I think we have a certain dilemma. At the moment, project prices still remain relatively high interest rates, higher equity return requirements. The revenue side is being affected by lower prices, also lower PPA prices. Something has to give, something has to adjust. Is it going to be project rates? Is it going to be higher electricity prices? What is your view?
I think that's a golden question. Yeah, what can be adjusted? I mean, the banks definitely they cannot lower the interest. They have the backup rate. The Euribor is like it is. There's a small part, which is the bank margin, which can be lowered, but it's not significantly. We have EPC parts when we speak about stuff which cannot be amended as well. EPC margins are as small as never before. Unfortunately, our Greensets Group is still in third-party EPC, so we're looking up at EPC margins of 6 to 8%. Also, this can barely lower. We have a situation, people have forgotten how difficult it was in COVID to get components to Europe. There was not a lot of movement to make an onshore factories, European component manufacturing. So this is something the EPC price itself can also barely lower. So we have, let's say, two parts, interest and EPC price, which cannot lower. So definitely it has to be somehow the project prices, or we need some kind of subsidies and kind of a strong program to bring electricity prices back to a sustainable level in order to use it for hydrogen, to use it for new cases. Unfortunately, EPC and interest definitely not. They definitely got two parts which can be amended lowered.
Thank you, Max.
Yeah, can I just add to that as well? Certainly on the wind side as well, just the other side on the turbine manufacturers' costs. Again, there's been a 30% increase in TSA prices. Part of, obviously commodities gone through the roof, but also kind of the profitability of all the major turbine manufacturers. It has to go up to a sustainable level. So again, on the CapEx savings there. So again, it probably comes back to this squeezing of equity again, but that'll happen first. But again, you have to compete for capital. Ultimately, it's going to be on the revenue side. It depends by market. Some markets will have tariffs and have competitive auctions, and you are seeing very transparent increases in auction prices for those markets. The publics of France, for instance, there's been a huge increase in prices. Ireland has got our auction regime, etc. So you'll certainly see things there, and we are seeing, for instance, Ireland is just a useful example that they had on solar. They've had two competitive auctions. The last auction was just last year. Prices went up very significantly, but still probably not enough because it wasn't inflation linked. So the third auction is due to happen this year, and they've significantly changed the terms and conditions, so they're including inflation linkage. They're putting in compensation for grid curtailment, etc. So and they have to do that because fundamentally the projects are just not getting built. They're not turning up because they can't make it work. That's, let's say, kind of a country's response or one country's response. It doesn't fit for everything, but it is acknowledgement of the challenges that are there. Certainly, where other countries where you have, let's say, the Nordics, where there's no subsidies, it's a combination of corporate PPAs and domestic and merchant pricing. There's a huge push basically to it's bigger projects. So it's large wind, small wind doesn't work anymore. And when I say small wind, it's kind of anything below 50 megawatts. It's really, really challenging. So if you want to bring subscale in there, the corporate PPAs have to go up, or pricing. So it's a mixed bag. For the jurisdictions where it'll be difficult, I suppose, is where you have just fixed tariff regimes or something that has not changed. That can be tricky because there's no lever to pull. So again, there'll be an adjustment. It'll happen over time, and the market will correct itself. But goes back to Max's point. I agree. I think capital costs are kind of here to stay. That's kind of there could be some small movement, but essentially I think we are at that. We just need to accept it, and we'll see what capital will do over time in terms of the cost of capital. So I think the pressure will all come back on the revenue stream again.
Thanks, Kevin. Andreas, you want to add something?
Sure. Really short. Given what we just heard, what it's going to come down to is that the developers are going to have to take the hits. That they, judging from last year's perspective, there's quite a bit of padding in the developers' margin, or was at least for that golden period we just had. But medium term, I think there's going to be significant consolidation within the market. What we're also seeing is a professionalization of the industry in general. Particularly speaking towards the German competitive landscape, where you had everybody and their mother basically opening their own development company. So there's going to be a significant change there, and also rationalization of the kinds of projects and how they're being approached. There's going to be sweet spots in development, as there were in the past, where certain project sizes just make a lot more sense to do, and the effects that we're really not seeing yet that they're going to grow much stronger, particularly in Germany, are going to be the effects of curtailment and the way projects were initially designed. And we're already seeing a shift from purely standard south-facing ground-mounted installations towards east-west facing, combining them with batteries, either integrated or standalone, in order to somehow ameliorate that issue into the future. All of that is really only starting now. We're going to see the effects of that in the next couple of years.
Thanks, Andreas. You've mentioned some interesting points, which actually brings me to the next item on the list, which is backwardation in the electricity market. Q4 last year was probably an era of gold rush. Everybody wanted to close PPAs. Industry off-takers were very reluctant to do so because they didn't want to lock in a high price for the next 10 years. For some industrial off-takers, last year's prices were just not realistic because it would have ruined their business plan. This year, or now, it's quite different because we are in a scenario where prices have dropped to the extent that project developers actually don't want to close at the current levels, whereas industrial off-takers would be quite happy. What is your view? What will have to change in the PPA market? For example, in Germany, we have the situation where the FIT, the feed-in tariff, is actually higher than some of the PPA quotes that are currently available. So I would imagine projects that have the choice between PPA or FIT would probably opt for the latter. What do you expect? Are the structures going to change? Are we going to see more pay as nominated? Perhaps even a different type of hardware setup? You mentioned east-west, battery storage. What's your view?
So I think that is a very interesting point on the last question. There needs to be more innovation. So basically, the solar landscape in Germany for the last, let's say, 5 years was very, let's say, non-inspirational and not very moving forward. It was always kind of a fixed system, better not do storage. Solar was very attractive. There was not really room for innovation. I think that is something which definitely needs to change. We need to really invest as Germany much more into storage. When we get back to the topic of the panel, securing capital. I had still last year, end of last year, it was very inspirational for me, a discussion with a large German bank about the senior financing of a large solar portfolio, tracker portfolio. So tracker, kind of the sun following a mounting rate, got probably 20% more yield, have 20% more installation costs, but over the lifetime it definitely makes sense. And the answer for this kind of system was, which is many of you might know in southern states, Spain, Italy, the to-go mounting system. They said it is too exotic for Germany. So same when we discussed some month ago, kind of storage project, standalone storage project. I said, basically this is maybe 1 year too early. Let's rather do it next year. So I think when we talk about innovation, when we talk about how can we move ahead, innovative project, tracker projects, storage projects, hybrid projects, including wind. There's definitely also the legal framework which needs to change. It should be much more easier to install and develop storage projects. And definitely there needs to be a lot of movement with the banks to really finance that movement. So when I see about attractiveness of financing solar assets, there's high attractiveness. Like I said, basically every large German bank who's doing project lending will throw money at you. But if you say, I'm going to develop storage projects, how can we finance that? This is the offtake stream, this is the revenue stream. There's basically from 10 banks, one is remaining. That's kind of a challenge if you really want to bring innovative solutions forward.
Would you say?
Maybe I can just very quickly add to that. I couldn't agree more. I pushed a portfolio or potential portfolio of BESS projects here in Germany, spoke to a number of banks, and the almost unanimous answer I received particularly from German banks was not really interested, or lending conditions that were so far out of the market that they made projects impossible. International banks who have experience with projects like this in different localities, different national nations, say UK, for example, which has a much stronger BESS market than Germany does, for example, more interested, but again, very challenging. And what I see here is that, particularly in Germany, the banks have just gotten used to the kind of subsidy scheme. It's incredibly attractive from a project lender perspective, taking almost all of the commercial risk of the actual project finance out of it for the bank, for the financing side. So yeah, you're going to get all the money in the world you want if you're doing PV development in Germany, but only if you stick within a certain limit of what the banks are already used to. Then perfect is if you're actually within a size where you offer a portfolio of multiple projects of a size that secure you that kind of subsidy financing that guarantees the project lender. I get that from a perspective, from the lender's perspective, from the security perspective. Really, what we're missing here is an interest in commercial development. Actual commercial financing, as it is usual in almost any other industry. It's our industry in particular that has been the profiteur of this kind of regime for the last 20 years. And at some point, and that's going back towards the whole correction angle that we're going to see, at some point that will have to change. The kind of scale that we're trying to achieve here will not be possible under a purely subsidy-driven scheme.
Thanks, Andreas. Kevin, would you like to add something on battery storage? I mean, Ireland and the UK, two markets that.
Yeah, I suppose as UK is obviously the most developed market in Europe, really, and it is very, very active. And there is non-recourse lending in there. Is an OB, I think in Santander, there's quite a large facility was done earlier this year, it's 35 million. But, the fundamentals of the market are such, you have ancillary revenues, you have sophisticated players, it's been on the go for a few years. You have like PPA off-takers that will underwrite a portion of revenues, provide floors, innovative structures that can enable them to come in there. The trend, so storage is everywhere in England because there's no onshore wind, as we know, for political reasons, but there's a huge amount of storage. There's a real trend now to kind of large-scale storage, 100 megawatts, getting transmission connected for various reasons, which in turn there's a huge amount of capital required for that, which in turn needs debt, etc. So that is shall we say, a function, it's a market that's really well developed, it's kind of coming up with its challenges, and it's maybe more to look to, albeit it has its own challenges, particularly when I noticed that 2-year gilt rate in the UK has gone to 5% today, so you can imagine the cost of capital there. So really kind of pushing things. But as an interesting market and kind of some of the solutions maybe potential for other markets as they, definitely look at the UK. Ireland is, like a lot of other European markets, it's an emerging market where we've actually ourselves, we've just commissioned our first batteries there. There is capacity payments, although they're significantly derated. It's basically a merchant market with a bit of contracted revenue. It's all equity. They are looking at reforming it, ancillary services. So we're probably a couple of years behind the UK, but it is coming, and we're not in a nation like the UK, so it's a fundamental need for batteries, and that is going to play. So we're going to be active there. If you want to take it kind of wider, we just keep it on the storage theme. Again, we're looking, as you see, Italy is 30 gigawatts of battery that the grid company, the Terna, kind of announced. And again, there's a huge amount of development going on in Italy, not knowing what the revenue stack is, and hasn't been worked out yet, but it's all been developed in anticipation that there will be some, so there's huge amounts there, likewise in Spain, and then the Nordics are again beginning to develop. So huge amount of activities going on. It's that's where the trend is, and this was the other thing just to mention in terms of optimization. It's rare now you see like a project being developed, Ireland, Spain, Italy, solar project that doesn't have at least a box in there, shall we say, to put in storage a container. So it's hybridization. It's all part of as we say, getting that value out, getting the returns up, getting the prices up for developers and whatever. We have to be clever. We have to maximize in this industry, maximize use of grid connections with grid is obviously particular constraint in a lot of European markets. So it's using those. So it's a combination of things. But the pure play solar, it is hard to make money, and it's getting harder. And storage is potentially one angle clearly on it.
Thank you. Greencells is active in quite a number of European markets. What other markets do you see evolving towards making EES investments attractive enough for investors apart from the UK?
I just want to answer the question of UK. Like Kevin said, that the market is much more developed. Just one thing to add for that. Is the market much more developed because there's simply more PS projects, or is the market much more developed because lenders are maybe much more actively looking into lending such projects? So, like Andreas mentioned, Germany, if we have now 2 or 3 standalone storage projects, BESS projects, it's going to be very, very difficult to find somebody who's giving you a good gearing on these projects. I think there's Germany not much behind than any other European countries. I really see UK standalone very attractive for these kind of projects. Everywhere the initiative starts, because I think there's some question how electricity prices will develop. But one thing is crystal clear, that there's a large demand in storage. So with all the question marks for storage, there's I think a lot of clear answers. A lot of question marks for electricity prices, a lot of clear answers in storage. I think there's a lot of initiatives in basically all of the countries, like Kevin mentioned, all the Sunbelt countries. They have such great summer irradiation that they just simply need storage to somehow balance the grid. I think Spain, Italy, Greece are countries which have natural great potential for storage projects. But also here, same like in Germany, to really realize it, to have more knowledge, to do research and development on storage on the grid, and to finance it. I think, despite UK, I think almost all European countries have sitting in the same boat and not having a clear path to best storage projects.
Thank you very much, Max. We still have time?
Not delayed, so if you come slowly to the end, it would be great. And if there are still some questions, we have to answer them.
Okay, well then some concluding remarks. Let's start with you, Andreas. Where do you see the opportunities, and what is your perspective over the next 12 to 18 months? Will you be investing, for example, in standalone BES systems? And if so, what type of revenue model would you expect in that sense, and how would that be financed?
Okay, that's a very, very long and complicated question with a much longer answer. I'll try and keep it short. So we'll definitely do bread and butter PV development, focusing on the fundamentals, because that just works. So long as the fundamentals are right, these are projects that will work for us. BESS is a more commercially risky investment, though I think there's a real coming demand in Germany for that. I personally think that's why we're pushing it, and that's where I see us going in the next 18 months. Trying to set up projects with the right fundamentals, and really build a German business on that, and then we'll survive the turbulence that is ahead of us.
Thanks. Kevin.
Over the next 18 months, is that the time period? Okay. I think there will be a period where we'll be, watching how the market develops, but I think we will be batteries, standalone batteries in particular. I think one thing just on batteries, particularly in UK as well, connection dates can make a huge difference on batteries in terms of valuation. So again, maybe the earlier the better. You have to make the right things, but particularly battery, I think over the next kind of few months is going to be hot topics. I think the other thing just to mention as well is solar, agrivoltaic, in particular to get one's head around it, like everything in Italy or substantial amounts of Italy and other countries where agrivoltaic could be permitted. Because there's natural advantages there in terms of how quickly it goes through. So that's probably the other big area to focus on over the next 18 months.
And you're also invested in wind. Have you looked at hybrid projects combining solar, wind, in the hopes of garnering a higher PPA price or better PPA conditions?
Yeah, it's funny you say that. We haven't as of yet. It's kind of complicated for us because we've multiple different funds and that they're owned by different things. It's easier to combine storage with either wind or solar. That's probably the first thing. It's probably more natural fit. The one market that it's on everybody's house in terms of is Spain in terms of utilization of assets and how that works. It doesn't quite work in other markets. So it's less of a theme. It's more for us. It's more solar and storage is a natural fit.
Thank you. Max?
I think Andreas and Kevin basically summarized really the market also very well, what can happen or will happen in the next 18 months. So for me, perhaps it's just two things which are very important for the future and two things we can wish for. It's a much more encouraged landscape of lenders, investors, like saying bread and butter business is PV, definitely, but in order to have that bread and butter business for the next 20 years, we need now to have much more encouraged lending scene, much more encouraged investors to build the baseline storage projects and infrastructure projects. And the second one is wishing for a good legal framework, like it was for me, for example, in Germany, is half-baked statements for windfall taxation, electricity price cap. That was helping nobody. So best for electricity prices and renewable market is states completely keep the law and the legal framework completely out of it, and the market regulates itself. So I hope very much that Germany, now letting the system running out and get back to self-regulated markets in terms of electricity prices and renewables.
Thanks very much, Max. Gents, can we take some questions still? Do we have time?
Of course. Are there some questions to the gentleman? Yeah, coming around. Here we go.
Thank you for this very interesting. Satish from Cedinus in New York. My question would be, in order to convince those lenders to create the next best revolution in Germany, what would you change from the technology dynamics of the market dynamics? One thing you would say. I'm very curious to know what could bring this in.
Different point. I'm so sorry, but I have to run at this stage. So I'll leave that question to you in the secure knowledge that you'll be able to answer. Thank you all, and it's been an absolute pleasure. Have a great day.
Thank you, guys.
Thank you.
Yeah, maybe if I can take the question. I know that the question is very hard because, like Andreas mentioned, if something runs out very well, never change a running system. For lenders, if they understand how PV cases are working, how solar assets are producing electricity, what are the risks, how can they mitigate, it's difficult to shift and to get to other kind of financing. But in a glance, it's very difficult, for example, for German projects, European projects, if the lender says you need at least 10 years of guaranteed offtake. So we need to somehow find a way to commonly agree that the produced kilowatt hour, which you produce, has a certain value in 2040, 2035. And it's difficult to determine the value, but it's the same like in the real estate industry. Nobody knows what the rent will be for a flat in 40 years, but everybody assumes there's a certain value. Why banks are financing a real estate project 30 years, 40 years. I think that needs to change. We need to align, although we might not exactly measure or forecast what the produced kilowatt hour might have a price in the future. There will be a price, and if we don't find it all now together, it's very difficult for all of them to realize projects. And then the next thing, despite this assumption, is simply in order to have a stable PV industry to have a stable solar project landscape, we need now to do storage, because otherwise the price will just completely go to the seller, will completely be absolutely too low. So what banks need to do is to align, basically find a way how to fund storage projects in large scale. It's very difficult if small developers, small storage developers go to lenders saying, okay, this is kind of a standalone project and I want a tailor-made solution. Kind of need to find a way how to put storage into larger portfolio for them.
So there are some questions left, or good? I think that was it for the moment. Thank you so much for the insights and for your time here on the stage. Thank you very much. And right after you, we have the last panel for today. So just a big applause for our experts here. Thank you.